Well, the Westpac Consumer Sentiment Index fell by 5.2% in June, and that followed a 4.8% fall in May. Now, the May fall was, I believe, largely statistical, related to the fact that we'd seen that big surge in April to an 11-year high. And the other factor, I think, was a degree of disappointment with the budget. I know the budget was well received, but I think the expectations for the budget were even higher than was the actual evaluation of the budget. So now we're about 10% off that 11-year high, which is not insignificant. Of course, the main explanation for the big fall this time around was the lockdown in Victoria. And we saw a 7.5% fall in confidence in Victoria, but indeed a 4% fall in Queensland, but around 10% reductions in both Western Australia and South Australia. But the big surprise was that confidence in New South Wales only fell by 1.1%. And that means that the level of confidence in New South Wales now is 15% above confidence levels in Victoria, around 11% above confidence levels in Queensland, about 15% above South Australia, and nearly 20% above the confidence levels in Western Australia. So what do we conclude from all of this? Well, I think it's firstly true that whilst the 7.5% fall in Victoria was entirely understandable, given they're going through the lockdown, the fact that the smaller states also fell quite sharply suggests to me that there's a degree of vulnerability, a degree of uncertainty in those states, that the signal from Victoria has been quite unnerving. And yet in New South Wales we didn't see that evidence at all. And I believe that suggests that there's a degree of confidence now in New South Wales that the governments will not move to shutdowns immediately in the event that we do see some leakages from hotel quarantine. And with those levels of confidence in New South Wales being so far ahead of the levels in other states, it's really important that the confidence level holds in New South Wales to ensure that national confidence remains in that positive territory above that 100 level. The other aspect that we saw in the survey was that there was a sharp deterioration in confidence around inflation. We haven't actually seen much coverage of inflation in the survey for quite a long while, but I think the evidence that we've seen of increases in fuel prices, potential sharp rises in wages, and potential sharp increases associated with supply chain disruptions are also starting to unnerve the consumer. Other aspects of the survey that I thought were interesting was that there was a 4.1% fall in the question, is now a good time to buy a major household item? That component of the index has been by far the weakest in this run-up that we've seen in the index since the beginning of the year. And I think what that's saying is that there's been a substantial pull-forward effect in terms of purchasing these big items. The statistics tell us that sales of durables overall are up by 12.5% this year, and spending on renovations and additions are up nearly 20%. Now that, of course, is reflecting the trapped money in the economy as a result of the lockdowns across the nation last year and the big payments that the government introduced, particularly through the JobKeeper package. But it's also telling me that the consumer spending outlook is going to be very dependent upon spending on services. Services are still down by 20% on a year ago. And so the small fall we saw in the savings rate in the national accounts this week, from 12.2% to 11.6%, which is still extraordinarily high. As that savings rate comes down, the majority of the spending that will be released should be going on services. But of course, the concern is if we see further lockdowns, that will mean that spending on services will be affected. So it's quite a complex story that I'm painting here. And indeed, when we assessed our growth forecasts for 2021 and 2022, we actually lifted them a little from 4.8% from 4.5% to 4.8% in 2021, and from 3 to 3.2 in 2022. But we actually reduced our forecast for consumer spending. Offsetting that was a sharp lift in forecast for business investment growth, from from 3.7% to 6.7% this year. We were very impressed with the boost in equipment spending that we saw in the budget numbers, in the national accounts, and we're also impressed the ongoing strength of business confidence. Of course, the budget was also very important from the perspective of business investment, with the sharp lift in subsidies for write-downs of business investment on depreciation. So, a pivoting, weaker consumer spending than we had been expecting, and much stronger business investment over the course of the next couple of years. But the risk, of course, is that we're still too optimistic with our forecast of 4.6% growth in consumer spending this year, given these developments with the lockdowns and the nervousness that we're seeing in other states in response to the news coming out of Victoria. The other big news is going to be the Reserve Bank board meeting that's going to take place in July. And we have changed our views on some of the policies that we expect to be changed at the meeting. We've now decided that the Reserve Bank will not decide to pivot from the April 24 bonds to the November 24 bonds, but we do expect them to be very flexible in terms of their announcements around quantitative easing. We expect that the Reserve Bank will announce a flexible program on quantitative easing, where they adopt a policy of buying $5 billion worth of bonds a week with an open-ended approach. But the rhetoric at the time that the Reserve Bank announces that policy will encourage the market to expect quite a substantial lift in purchases. And we expect that our original forecast of about $150 billion in further purchases once QE2 ends is still going to be in place. That'll see QE extending well into 2022. And by that time, we expect that the Reserve Bank's bond portfolio will be about 18% of GDP and around 36% of the total bonds on issue, which will still be lower than most other major countries, but still a substantial stimulus from the current levels of 10% of GDP and 30% of bonds on issue. Thank you.